My name is Kamal Warren, and I day trade the FTSE 100.
About the 30th of April?
Okay, I think what's interesting on the 30th of April, is if you look at the 15 minutes chart. I don't know if it's very obvious on the 1 hour. Let's have a look as well. Not really, but if you can see the 15 minutes chart, I mean, anyone looking at this can tell that there's two peaks sticking out like a sore thumb here, left and right. And this again is known as a Adam double top formation. So again, like what I showed on the 5-minute chart earlier, you're looking for I mean, this doesn't happen very often. When it happens, you just got to jump on it, and obviously hoping that the price does what you think it's going to do. So you draw your breakpoint around, oops, not there, it's not very well drawn, so around about there. So you're looking, so effectively what's going on there is the price, the market is trying to, it's made a high there, it's trying to move up, trying to punch through that. And according to chart pattern principles, when the break happens, if it doesn't break above the resistance there and it breaks below the lowest low in the chart pattern, that means it's going to slide down. But obviously the trick is for you to see if that happens, where you're going to take your profits at. So again, this is where momentum indicators come in handy, because you can see at the left peak the momentum reading is extremely high, but on the right peak it's extremely low. It's a massive drop. Yeah, so that indicates that the buying pressure is lagging. When buying pressure lagging, that means the market is going to tank. And when the break happens below the double top at this mark here, which is 845, you go short at the next candle, either on the 15 minutes or the 5 minutes, whichever chart you're looking at. And true enough, the drop for the day it's quite significant. If you go back to the 5 minutes chart, you'd have opened your trade there at about 9 o'clock. There you go, that break there, that's where you would open your short trade. And where would you place your profit taking is where you bring in the Fibonacci levels. So if you take the lows, the previous low before the peak, and I pull it up, you can, well, that's quite far down for a day trader, I would say, but it did hit the mark around about 3 o'clock, but I would have taken profit around about here, because I don't have the pivot points for this particular day. I got to calculate it manually, but if the pivot is somewhere around here, can you see the action there? It's just gone crazy there. It just doesn't know what to do, because it's thinking whether it's going to bounce here or is going to punch through. So that's why this price action is going on, but the market was so weak, it just dropped all the way down. So that's what you would look to do. So you would short there, and then you can take your profit, target your profit levels there. And your second trade, this is where it becomes very interesting, because even if you open there at 9 o'clock, your first trade would have taken profit at, say, around about the 50 mark, 450, and it never ever touches your opening point, and it slides down all the way. You'd have quite easily made, let's see what, here it says 5 minute, 5, 10, 15, 20, 25, easily about 30 pips, plus your initial trade, another 5, so 40, 45 pips profit for the day, depending on how much you trade per point. It's going to be good profit actually for the day.
So what's the reasonable number of pips to make in a day?
Well, on a good day, depending on how the markets, I mean, this is pretty much pretty good day. You have bagged 40 pips easily, which is good going. But on average, I think depends on what the market does and your trading style. If you target, well, I personally don't have a target per se. I've got the profit target. If it's 5 pips, that's what it is, because that's just how it is. But because of the two trade principle, you want to back the additional moves, and that's where a bulk of your profits are made.